The UAE real estate market is drowning in noise right now, confusing investors. Headlines are screaming about billion-dollar casinos coming to Ras Al Khaimah, next big opportunities coming to Abu Dhabi just because theme parks are opening over there, and these are your next Dubai opportunities where you should be investing yesterday. But here's the catch. I'm about to show you 3 filters that separate expensive mistakes from million-dollar investments. And by the end of the video, you will learn how to separate noise from the true real estate opportunities and why only Dubai is passing through all the filters, and that's why I've invested my personal money only in Dubai's market. Quick context for those who don't know me. I'm not just a random real estate guy. For 12 years in investment field, serving as the CEO of investment group, serving as a minister for investment in one of the Russian regions, and being in charge of government's biggest project back in Russia of building a new city from scratch, creating economy and a master plan for 200,000 new residence city. So I know a thing or two how value is created one side, and on the other side how institutional grade investments are assessed, how you look for value for money and undervalued assets. So with this combined unique experience, I have my own lens how I assess the market and its opportunities, and what I'm going to share with you is unique because I've created these 3 filters and you can't find it in other videos, and you can't find it with the real estate agents or with the consultants. It's personally mine and I'm sharing it with my clients, and now I share it with my audience. And final disclaimer, the filters and the frame of how to look at the real estate markets I'm sharing today in this video is applicable only if we assess the investment side of real estate. If you're looking for a home to live, for your residence, home for a family, this filter is absolutely not applicable. There is another filter, how to look at properties. So now let's get to the frame. And first, very important pillar how we approach any market for any kind of investment is liquidity. Liquidity is often misunderstood. It's not the appreciation on paper, it's how fast you can turn your asset into cash. And from this point of view, the size of the market is in a direct relation with liquidity. The time of exposition of your good, of your asset, is in direct correlation of how many people are in this market. An illiquid asset that can have high appreciation on paper means trapped capital, and that's when you cannot liquidate it and turn it into cash. So we want to avoid that situation despite promising future on paper and flawless appreciation perspectives. Dubai have been working towards this sentiment and perception of the market for the last 30 years. It's been appealing to international investors, building its attractiveness and working towards being #1 destination for foreigners. So if someone gets on the same track today, he's 30 years away from the work that Dubai has already done, and it perfectly illustrates the size of the market. Dubai Mall has the massive footfall. If you want to rent a shop in Dubai Mall, you will be paying some of the highest rents in the world, which are fairly compensated by the traffic and the footfall, which results in revenues and in profits. So we are not just looking at the rents rates in Dubai Mall, we are looking at how fair it is against footfall and buying capabilities of those who are passing by your shop. That's why people are standing in queues 5 years or more to get a spot in Dubai Mall. So in our case, investors' property in this Dubai Mall is exposed to a vast and deep pool of potential buyers. Conversely, emerging markets like Ras Al Khaima and Abu Dhabi, we can compare to a local shopping mall where if you are sitting with the perfect good, the best one in the world, it might take months or years before a proper buyer steps in and takes it from you. It has nothing to do with the fact that the good that you have is flawless. The main point here is the size of your shopping mall, or the size of the market where you are operating. So before going into properties details, we should understand where we will be exposing it to our next buyer. Pillar number 2 in our frame is risk to premium ratio. That's the highest level proportion how we invest into anything. If you are investing in stocks, bonds, crypto, etc., everywhere you will find that this ratio should be in favor of investor. The amount of risk you take should be compensated by the expected revenues and returns. In our case, in real estate market in UAE, we should not just look at total price of properties or price per square foot in each of the Emirates. We should look at ratio. Let's say if Dubai is a global benchmark and of course the main market to compare to Abu Dhabi, Ras Al Khaima, Khurfakan, etc., then what is the price difference and what is the amount of risks you take when you are investing in other Emirates? Is it adequate price to potential profits? And we will go through that in each Emirate, and I'll describe what kind of risks you might face as an investor in each of the Emirates. And the pillar number 3, how bulletproof are your assets? When we are measuring and looking looking at potential profits. Always seasoned investors ask, what is the worst case scenario? What will happen if bad things come to life? What kind of risks we are expecting and what will happen to the price of my asset in that case? So when you are investing a lot of money, the first question is not how much I will make on that amount of money. The first question is how not to lose the money. The second one is what I will get for the risks that I take. So from this point of view, it's very important to look at what happens to your money if market goes down, if we have any risks that come to life, that materialize, and what happens to your plans. Do you have plan B for that asset? Do you have any kind of other exits from that property? Like financial markets, real estate market can face cycles or downturns. While Dubai is the most famous destination in Middle East and Africa, we will be looking at kind of risks that can take the whole region down in terms of markets and liquidity. Not only in real estate. Let's imagine something like COVID-19, like a regional war that takes all the markets down. Saudi Arabia, Qatar, Dubai, etc. So some major risks, not going into the level of price declines, short-term price fluctuations. That's not the level of risks we should be assessing on a timeline of 3 to 5 years. We're looking at the big things. What can drive your assets price to zero or almost to zero, or what can drive you in a situation where you cannot exit your assets. So that's the final pillar for this frame, where we try to imagine all possible major risks and what happens to your assets in this situation. So now using this frame, let's deconstruct the hype and the noise and everything you've heard about these three markets. Let's start with Ras Al Khaimah and casino. This market, we can't call it really yet a real estate market. All the modern development of Ras Al Khaimah's freehold properties began with the idea of casino license coming to the Emirate. So everything what we've seen by far developing since 2022 was connected to that casino development. Totally brilliant idea. Of course, it drives a lot of interest and a lot of people coming to play the casino or to stay in resorts, even not connected to casino. They might be enjoying the general touristic destination amenities, but in general, majority of people are buying properties in Ras Al Khaimah, investing there with the sentiment that they will be successfully renting them out to tourists coming to casino. But when run through these three filters, this market appears to be standing on a very fragile foundation. And the first pillar, market size, that we discussed. Actually, if we look into number of properties bought and sold, is the size of the market in our case. So if we look into that, in 2024, we had 2,985 transactions in total. That includes off-plan, secondary. I don't have data how many transactions out of these were done in secondary. I assume that majority of them, 90%, were done in off-plan. So this figure is dwarfed by activity in Dubai, which saw approximately 180,900 transactions. 60% of them were done in off-plan, 40% of them were done in secondary market, meaning that 40% is the size of the market where you will be selling your property if you want to exit. So you have 2,900 transactions in one emirate, you have 180,000 transactions market on the other side. So that's the liquidity understanding for us. More critically, for an investor looking to realize profits in the secondary market in Ras Al Khaimah, it still doesn't exist. And if we do a deep dive into transactions, we can also assess the total sales transactions value. So if in Dubai we are talking about 522 billion dirhams market, in Ras Al Khaimah we are talking about 6 billion dirhams market. I truly understand and I fully agree with all the fantastic perception and idea and inspiration behind a casino coming, but a casino has its limits. It has a number of people daily that it can accommodate, I mean the players, and if I'm not mistaken, it's up to 10,000 people who might be playing in casino, gambling in casino, while the hotel itself, the Wynn Resort, can accommodate and has around 3,000 hotel rooms. So if we are talking about approximately more than 20,000 units launched by far in Ras Al Khaimah, is it fair to think that all these properties will be demanded on Airbnb by casino players while we have enough hotels launched there? We have Wynn Resort itself, and we have behavior of our target audience. Most of the players, they don't want to stay in Airbnb apartments around the world near the casinos. You know, it's an expensive vacation for most of them. They are not trying to save money. So I highly doubt that casino players will be a kind of target audience. If we exclude that, what is the next target audience we have in Ras Al Khaimah? Well, I would say are people coming for beachside vacation. Fair, but in this case, Ras Al Khaimah is now stepping into competition with Dubai, which is the destination for this kind of activity and this kind of holidays for the last 20 years. And we are competing with Abu Dhabi, which has a very nice set of Airbnbs and hotels already. So here you should also assess the chances that the Airbnb apartment that you are you're looking at in Ras Al Khaimah will be competing with these two Emirates, which are way stronger, way ahead in terms of the tourist appeal and infrastructure development. Now we look at pillar number 2 of this frame, which is risk to premium. So the entire investment thesis of Ras Al Khaimah currently stands on the appeal of the casino. And you should be asking a lot of what if questions as an investor. What if casino is delayed? Or what if casino segment opens in second or third phase of resorts development? What if number of layers coming to casino will be growing gradually, not instantly coming to the full capacity? When you understand that all your investment is depending just on one thing, on the casino and its development and number of people attending it, you are taking a lot of risks on the capital that you're investing. And first and primarily, as I mentioned, the accommodation for casino visitors and the primary choice will be the casino hotel itself, the Wynn Resort. Then people will be looking at other hotels and resorts nearby. And only in third row, they will be looking at Airbnb apartments. So when some developers, reputable ones, selling properties in 40 minutes from casino saying that these properties will be demanded by casino players, I want to come to the respected company's sales executives and have a serious talk with them, because that's actually damaging their reputation and the common sense of salespeople in the sales gallery. So do not expect that number of casinos visitors is an infinite number that will grab from the market any Airbnb unit that is in 1 hour's drive or by boat from the casino itself. There are limits and you should know them, and how many properties against that limits are already sold. Second, the pipeline of residential supply around this single demand driver is fantastic. So in a pipeline of residential supply around the single demand driver, we have around 11,000 new residential units that will be delivered by 2030, and other estimates placing this figure as high as 14,000 units. So majority of them are located in Al Marjan Island itself, and that's a direct competition for the same pool of potential tenants. Yes, that units can be, of course, as we discussed, demanded by tourists that are not gambling in casino, but still you should be having these numbers with you. This creates a scenario of intense competition. When you have an intense competition with a stock of apartments for the tourists, you will see the prices slow down or the rental yields going down, which will mean an imminent downturn in prices of that properties, because if your asset is generating low cash flow, it cannot cost a lot of money. There will be a ratio that we can see now in Dubai. If you buy property today, put it on rent tomorrow, you generate from 4 to 7% rental yields. That's the ratio that you can understand from your rental yields what will be your resale price if today you buy something from the off-plan market. Now, if that cash flow is not proven on paper, what you are expecting today is not proven on paper tomorrow when casino launches. If your property is not demanded for 2, 3, 5 years per year because of the intense competition, you have to put your prices lower. You will have lower cash flow and your resale price cannot really go up. So in this case, you are taking a lot of risks. What I'm trying to say in this pillar, as you remember, we are trying to assess first the size of the market, then risk to premium ratio. And here you have a lot more risks compared to Dubai when you are depending on one stream of potential buyers or tenants. And second, you don't have a mature market. If we exclude casino players and we exclude a minor group of tourists that will be looking at affordable holiday, let's say, compared to Dubai and Abu Dhabi, there are no more people that are interested in these properties at this stage of market's development. So it takes us to some risks when we cannot exit this property. And these risks should be compensated by way lower prices compared to, let's say, Dubai, which is the benchmark market. And if we actually look at the price differences, we are now at 15% more or less lower prices in Ras Al Khaimah compared to Dubai. And in some of the fancy projects, we are at the same level of price per square foot. So does it really make sense to take a lot of additional risks in this case if we have only 15% price difference? And you are also exposed to major risks. What happens to this market if Dubai goes down? If major regional kind of risks come to life? Can you really exit these assets? So that's the questions you should be asking. I'm not going to answer them for you in this video and saving your time. Now, to conclude, you are paying almost the same price as in Dubai and taking a lot of what if kind of risks when stepping into this market. Now, applying the same filters to Abu Dhabi. Investment proposition here is markedly different, and on surface it can be looking more appealing. A lot of family offices, investment funds and big capital is relocating to Abu Dhabi. That's true. A lot of people from finance field are attracted by Abu Dhabi's appeal as the financial center, and on top of it, Abu Dhabi always been the oil capital and the capital of of the country. So Abu Dhabi started opening its freehold properties market in 2019, if I'm not mistaken, and now it's on a good track to be globally appealing to investors to go for their properties. But again, we use the filters, not just generalizations. So if we look at market size and liquidity and number of transactions in our case, Abu Dhabi's real estate market operates on a smaller scale again than Dubai. We take data for 2024, where Abu Dhabi's residential market recorded approximately 9,700 sales transactions. While it's a bigger number than in Ras Al Khaima, keep in mind that Dubai had 180,000 transactions. Now, when we look at Abu Dhabi's resale transactions volume, it's actually the size of the market that where you will be selling your property. That is 4,300 transactions. So, and resale transactions value for Dubai, if it is 294 billion dirhams, in Abu Dhabi it's 9 billion 200 million. That's the difference in liquidity that is directly connected to the time of exposition of the asset that you want to sell. Now, Abu Dhabi is 16.5 times smaller market right now currently. I agree with all the sentiments and with the appeal and with the perspectives, etc. I'm stating facts for today. And this data dismantles the safe harbor kind of appeal for this market today. It's where you can have nice appreciation on paper right now, but when you are trying to exit the asset, you are facing some issues, let's call it that way, because the time of exposition of your property will be way higher compared to Dubai. So when we compare and we apply pillar 2, risk to premium, Dubai's market benefits from, as I said, 20 years of the work of appealing to foreign investors. And it has built a global brand and world-class infrastructure that just started to become a very convenient and appealing city in 2020. Imagine that Dubai has been building that for a long period of time. And only after COVID, it gained enough gravity that now families are moving and voting with their money for Dubai as the best city with the best infrastructure to raise the family, to raise kids, to live conveniently, to get all the services and experiences on the highest level in the world in this city. So Dubai have been building this appeal and infrastructure for more than 20 years. Abu Dhabi, as I said, on a good track. Still, it doesn't have the same level of development and appeal to families and tourists. So things take time. Even if you have all the money in the world, what we see in Saudi Arabia, you can't make 9 women sit around and give a birth to a child in 1 month. So that way you cannot create a city appealing to globally people all around the world in a shorter span of time. You need to build things. They take time. Now, someone might say, okay, I buy now and maybe I exit in 5 years. By that time, Abu Dhabi will be a bigger market and I will face no issues. Let's imagine that. If we have 16.5 times difference in the size of the market, maybe in next 5 years, even if Abu Dhabi will be doubling the size of the market, which is pretty impossible, you know, things and capabilities of construction, they take time. It's not a software that can be scaled overnight. So even if the market size doubles each year, still you will be on a market that is not 16.5 but 8 times smaller than Dubai. So you will be facing same liquidity issues in 3 and 5 years. If you are planning to buy again property for personal use, this is not a question for you because you will be living there for the next 10 years, 7 years, and investment side is not primary target for you. Perfectly good place. Abu Dhabi's nature is fantastic. The Saadiyat Islands, the beaches, the mangrove forests, they are so beautiful and anyone will be happy to live there. Believe me, I've been there. I've lived for a couple of weeks in different places in Abu Dhabi. It's really a fantastic place. If you need to be, by your nature of your work, if you need to be there for the next 2, 3, 5 years, definitely you need to buy a home, especially on the seaside until that's available, and not to think of liquidity, not to think of the potential of appreciation just because you need a home there. Better to buy and then next 10, 12, 15 years, you will not lose money reselling it. You will gain some profits, but we cannot calculate what kind of profits. And anyone promising you great exits and fantastic profits and the better opportunities than in Dubai, they don't understand how investment works and where to look at. Not the specs of the properties, but how many buyers are there who can actually buy that property? That's the first question I'm asking. So if you are looking at Abu Dhabi because you need to be there because of your work, buy property. If you are looking purely from investment side and you want to make money on real estate. So by the size of the market, Abu Dhabi is second market and is connected to Dubai, of course, because Dubai is leading this real estate game in the region. And even again, as we discussed, if it doubles every year, still Dubai is also growing and it's impossible for Abu Dhabi to catch up with Dubai in next 10, 15 years. So this dynamic also it reflects in capital appreciation rates, while Abu Dhabi's market demonstrates some stability and steady growth, it doesn't match the explosive performance seen in Dubai's prime segments, because still Dubai also has DIFC, which is world's #7 financial hub right now. DIFC is expanding. We are building DIFC 2 now, which will attract more residents, more family offices, banks, insurance companies, etc. So Abu Dhabi and Dubai, even in financial sector, not talking about all the other appeals of Dubai that Abu Dhabi doesn't have. In financial sense, Dubai is also growing and evolving. There is competition for people from finance field between Abu Dhabi and Dubai. So residential property prices in Dubai rose by 19.4% in 2024, where apartment prices in Abu Dhabi increased by approximately 9%. So when you have a lot more people who want to buy properties than there are on the market, you have this surge in prices, right? So if Dubai has a bigger market with 180,000 transactions and prices are growing that much, it means there is even bigger amount of people outside of this mall. As we discussed, if Dubai is a mall, and there are more people who want goods from this mall than there are goods inside. While in Abu Dhabi, even for that smaller market, you have less people outside of the mall who are buying them. That analogy explains the gross difference. While if the amount of people who want properties in both cities were the same, then Abu Dhabi would be growing by double digits higher than Dubai, and that will be also explainable because it has lower supply of properties. But yet it has now, from investment point of view, again, Dubai is more appealing. It has more people who want properties here, and the growth in prices reflects it. So the nature of demand shows that in Abu Dhabi, if you are going for properties there, you will be doing better if you are going for high-end properties, if you're going for beachside villas, expensive projects, catering to top guys in financial field that are mainly now relocating to Abu Dhabi, and that's the core audience who can buy properties with premiums, who can pay premiums to get a proper level of property. So high-end segment, ultra high net worth individuals, and the properties that cater to them. That's a small segment where I can see opportunities. And for the mass segment, for apartments, for mid segment and lower segment of the market, still Abu Dhabi doesn't have enough gravity to attract a lot of people who will be willing to pay you more, to pay you premiums to get property from you. So whom Abu Dhabi is attracting right now is ultra high net worth individuals, and they are able to pay you premium to get that scarce product, which is big villas, luxury properties that cater to them. It's a micro market inside Abu Dhabi's real estate market where you can make some profits. So if we go for the final conclusion for Abu Dhabi, exceptional city, a very nice nature, a very nice appeal to ultra high net worth individuals, but if we compare liquidity and risk to premium, Abu Dhabi is not of any competition for what Dubai's market offers right now to investors. So now let's talk about Dubai. After deconstructing the hype and marketing appeal of all the Emirates, look at numbers and actual performance of Dubai's market. In 2024, Dubai has seen, as we discussed, 180,000 transactions, and we've seen 110,000 new investors, the people who are investing first time in Dubai. So this market attracts a lot of foreign investors' attention. Actually, it's a global leader right now, not only in MENA region, but in the world. Especially that's evident when you look into the luxury home market. For the properties priced above $10 million, in 2023, Dubai has seen 431 transactions. It's higher than such traditional luxury hubs like London that saw 240 sales, and New York where we have 211 sales, and that's underscoring the Dubai's status and appeal right now. As I said, it gained such a big gravity in terms of how it's appealing to different groups of investors, not relying on single target audience, that it became globally #1 city where people are willing to invest, and these numbers show us facts, not assumptions, but current situation. So the deep liquidity of the market attracts more international investors, and it creates this virtuous cycle. So you are buying property, you know whom you will be reselling it. There are enough people who want properties, and if you have 110,000 new investors just in 1 year, so you will be much better here on Dubai's market compared to smaller respected markets in other Emirates. Another thing that separates Dubai from other markets is target audience and the portrait of buyers of properties. In Dubai, we are talking about all the possible demographic, all the possible target audiences that need properties in the city. We have families moving in, not connected to any job inside Dubai, like people connected to any remote work, influencers, engineers working in other countries and raising children in Dubai, because one of the unevident reasons why families are moving to Dubai, because it's traditional values city. A lot of people coming from UK, US, Germany, they tell me they relocated to Dubai not for economic reasons, not for other things, but because of the environment. They want to raise their family in the way how families are used to be raised, not in the way how now they are taught to be teaching their kids and raising the family. Another group of people, tourists. Dubai sees constant surge in number of tourists visiting the city. Every 1,000 of new tourists in the city need in general one Airbnb additional apartment. If we have now 17 million tourists per year and the number is growing, 1% of them turning into residents. They are relocating or they are buying properties here. And for each 1,000 tourists, we need at least one additional apartment on Airbnb. It's a big and proven and resilient market for Airbnb business and for the number of tourists. We have doctors, engineers, finance guys and financial field. We have exhibition sector. We have production sector. For the index of production activities, UAE became #1 in MENA region and in Arab world. So Dubai is a significant portion of that production activity. Logistics. So 25 different sectors are contributing to Dubai's GDP and attracting talents and business people from all over the world. When people are saying that, jobs market is not big enough to attract more buyers of real estate, these people are stuck in the perception of city's economy from 70s. We are not in industrial age of economy. In post-industrial age, it's not jobs created that attract people. It's vice versa. City's economy attracts people who can create product, value, and services for this city's residents, and so that they create economy and jobs. So any economist will tell you that city's economy and GDP is not connected to the jobs market that existed before, so that we don't need a factory standing somewhere so that the city grows attached to that factory. That was relevant for industrial age. I'll give you an example, the one that we all understand. Let's take hospitality and restaurants. Dubai had enough of them. After 2022, a lot of Russian and business people started moving to Dubai just because they were pushed out for different reasons. Now, a lot of them were coming from, let's call it, services and hospitality. When they started creating their products in Dubai, what happened is that they raised the bar for the hospitality services and for restaurants, cafes, for HoReCa in general. Does it mean that these people before moving to Dubai should have been attached to some job market? No, there was a market already, foods and beverages. They entered this market and they didn't take jobs from others. They raised the bar for the service and for expectations what a restaurant, what the best restaurant in Dubai can offer. That creates additional value and additional spending by residents and tourists, because these higher level services create higher perception and higher spending. When these people moved in, when they created a lot of more cafes, restaurants, added a lot of value, they didn't take jobs from others. They created additional value, and people are paying for that additional value if it's value for money. So you can apply the same to production, to any other sector in economy, and to real estate. A lot of new companies entered the market. They create way better products than the companies that were traditionally in this market. Majority of my transactions with properties for the last 12 months were done with the new companies. They give you a lot more value for the same buck that you are spending. So that's why, to conclude this point, the properties on the market should be attached to the jobs market is wrong. Now it's very different. The economy has changed and production is just one of 25 different sectors contributing to Dubai's GDP. And yes, please keep in mind, Dubai's GDP doesn't have oil revenues, less than 1%, so it's neglectable. And please stop this nonsense about if oil prices go down, up, sideways, or whatever. Real estate in Dubai is not dependent on oil prices. Maybe it's more relevant for Abu Dhabi because now Abu Dhabi's government is investing a lot of oil revenues into infrastructure and into developing the city. So prices going down might affect that spending. But for Dubai, it's not relevant anymore. The infrastructure that attracts people is already in the place and it's not funded from the oil revenues. So now let's talk about stress test and how Dubai weathers a storm. I think the worst crisis ever for a city like Dubai with a big touristic sector was COVID, when actually eventually you shut down the services, the whole sector, and a lot of businesses that are attached to it. So if Dubai came out of this crisis in the best possible way, it was awarded that the leadership and the management of UAE was considered the best practice and the best management solutions in the world. And that gave a lot of confidence to international investors in the real estate here. So if this is the same leadership and the same team in charge, then you can say that any major risk that this market can face will be managed with the same success rate. If the market will face correction in Dubai, let's say, we should try to imagine what will happen to much smaller markets like Abu Dhabi, Ras Al Khaimah, any other emirate. If you can face 10-15% correction as Fitch predicts, which I'm not, by the way, considering any kind of reliable source of information, what happens to smaller markets where now during good days there are less people who want that properties? What happens when Dubai as a benchmark and the main market to which other markets are connected? Dubai is promoting UAE in general and opportunities in real estate in UAE in general. If it faces some problems, what happens to attached markets, especially given that they have way smaller size? That's another question for you that will face some liquidity issues. And when we go for further risks assessment, a market like Dubai has something that we can call bulletproof investment. A bulletproof asset is something that has inelastic demand. That is something that is not connected to general market's performance. Let's imagine that we have 30% correction tomorrow in Dubai. There are properties that are not connected to general price of square foot in Dubai. That is possible because Dubai's market is big, it's not even. There are areas where you have more properties than people willing to buy them, and there are areas where you have already demand and people, but you have zero supply. So you cannot combine these two, divide them, and come with an average. Like Bill Gates entering any pub makes everyone in average a multimillionaire. But does it give you any info for making an investment decision? No. The same way what these Fitch reports and Bloomberg experts say doesn't give you a proper information for investment decision. There are bulletproof opportunities only in Dubai's market where you can be confidently investing and getting even higher returns than in these two emerging markets, just because you already have demand over there but you don't have supply. Like Expo City, where I sold 4 buildings already, a lot of individual units, and where I'm investing myself. I'm giving you this as a bright example. There are other areas like that also in Dubai, but what it tells us is that government's power is shifting the Dubai's exhibition center from the World Trade Center into Expo area. So in this relatively small spot of land, you will see approximately 2.5 million visitors right next year. It's what we had in World Trade Center last year, the number of visitors. They were coming for 300 events in the World Trade Center area. So the same demand is shifted to this place. But when you look at the accommodation offers, you have 300 hotel rooms right now in a Rove Hotel and approximately 150 rooms in an expensive 5-star Cheval Blanc hotel in Expo area. That's it. That's the total supply for approximately 8 to 10,000 people daily for 300 days in a row that need accommodation. Nature of demand there is a short-term stay or people coming for participating in events or visitors of events. They don't care what is the average price of square foot in Dubai. They need to stay here in walking distance from the venue for next 3 to 7 days. That's why they will be willing to pay higher rents, not to use taxi and metro, right? Because if they don't get any properties or any accommodation here, their next stop is in 15 to 20 minutes drive in Marina area. And Marina is not the cheapest place to rent apartment or hotels, right? So options for the visitors of this exhibition center, and we keep in mind there are 2.5 million of them starting from next year, is either to pay high rent and to stay in walking distance or to travel 15 minutes every day for the next 3 or 7 days while they're here for the event. These people don't care if there is price correction coming. If the properties in JVC or in somewhere else in Dubai cost less or cost more or whatever, okay, that is kind of bulletproof investments where you are detached from average market's performance. Another example is beachside properties. 17 million tourists are coming to Dubai and 60% of them are coming for shopping or seaside vacation. These people don't care what is the average price per square foot in JVT or in Dubai Hills or in Creek Harbor. They're not going to Creek Harbor. They're going to Dubai Islands, future touristic destination. They're going to JBR and Marina. They're going to Palm. So they are here for 1 week with their family for a seaside vacation, for sun, sand, water, and some touristic attractors. For them, two choices are on the market: a hotel room, big enough to accommodate a family, 4 or 5 people, or a cheaper option, which is an Airbnb apartment. That's it. So they need a walking distance to the beach or to the shopping mall. They are here for 3 days or for 1 week. They don't care what are the prices and if they went up or down or sideways. These kind of investments are called bulletproof. Again, that's me calling them bulletproof. I haven't seen that from agents, from videos and advisors with no real estate license. There are a lot of them, by the way, in the internet. Be cautious. There are a lot of people who want to benefit from selling properties without taking responsibilities. You know that when you are getting a broker's license, you are responsible for what you are saying to a client, and you can face legal consequences. Not many people know that it's not just saying anything. If you are not properly advising your client, you will face consequences. So not to face them, there are people acting as investors, sharing their opinions and experience, and they will refer you to a link where you can do coaching with them. So beware that that's the way how to dodge responsibilities. Okay. And there are kind of coaches that can coach you how to invest, and they will charge you some money for consultancy. So neither these guys or agents ever talk about the general market's performance, the bulletproof options you can invest, and they don't have enough just knowledge and dedication to understand every metric, every segment of the market, performance, risk to premium ratios, and what is the balance between price you are paying, value you are getting, risk to premium ratio you are getting. So that's why you need someone who dedicates full time to understand this market only, not someone doing 3-4 things simultaneously, right? My work as an advisor and a licensed real estate broker to save your time, to provide you with reliable data for your decision making. So that's where I'm adding value. And that's why I want to warn you also about the important thing for decision making, which is called the quality of advice. If you see influencers or views chasers in YouTube, doing these faces, Dubai crash, bubble, oversupply, we've seen a lot of them. That is done by people who want to get paid for selling properties but don't want to take responsibilities. They don't dedicate 100% of their time. They don't do homework to give you quality advice. And if you ask them the first question and most important one, what is your qualification, education? What is your achievements or any other proven track that makes your advice qualified? What is your competence in this to advise someone on investing in properties of $500,000 and above? You will hear a lot of irrelevant stuff. So if someone bought 2-3 apartments in Dubai and now is giving you advice how to do that, that's not kind of quality of advice you want to get, because 80% of deals in Dubai are bad deals where people don't make money. Like in any other market, not everyone can be winning, right? And to understand where are these 20% deals that actually make money, you need someone who is 100% dedicated to that particular task. Of course, in this regard, I'm telling you, I'm property advisor, I'm real estate agent, but I'm proud with the number of hours and years that I've dedicated into bringing something to the table when I'm giving you an advice. So if you want to talk, or by the way, for free, I don't charge advisors hourly rates for that. There is a link in the description. And the conclusion for this video that I want to bring to you, and the general topic, is that the analysis that were presented today give you this outcome. Ras Al Khaimah market currently is standing on one perception and one main driver, which is very risky. The Abu Dhabi's market is not even, and the investment sense can be made only in the high segment, in properties priced at 10 million and above. That is what is considered ultra high net worth appeal and properties. For Dubai, you have a benchmark market which has the highest liquidity, the best risk to premium ratio, the biggest number of investors in the world in real estate market of a global city, the resilient, and in this market you have sub-markets where you have bulletproof investment. So if you want to learn more, go into the level of projects and to understand where we can invest, what are the expectations for that kind of investments, let me know in the comments, or there is a link for a consultancy call and my WhatsApp number for a quick chat.